Alkyl Amines is a specialty chemicals company with leadership position in the chemical segments that it operates in. If you look at the last 5-year financial history of this company, the revenue has gone up a little more than three times from 501 crores to 1685 crores. And the profit after tax has gone up by about 4.5 times. This is a fantastic uh, performance. Right? If you look at the stock price history, then the price was about 286 rupees in Jan 2018, which has gone up to almost 2700 rupees in Jan 23, which is 10x returns, which is a staggering 58% CAGR in the last 5 years. But what has happened to this company in the last 1 year? If we look at the 1 year stock price performance, then the price has actually fallen from 3,730 to about 2,730, which is a fall of about 25%. In fact, if you look at the all-time high of this company was about 4,300 rupees in July 2021. Then in the last 18 months, this stock price has actually fallen by a massive 40% from its peak. So why has this happened? Let's look at the usual culprit, right? Valuations. This company had a PE ratio of approximately 61 just 12 months back, and even today it has a PE ratio of 61. So this is not a problem of valuations becoming cheaper. So where is the problem? Let's look at the balance sheet. Right, this company has been expanding its capacity over the years. In fact, it has gone on for aggressive capital expansion in the last 2 years. And what we see is in the September quarter is that there is a staggering 300 crores of capital work in progress. So the company is continuously expanding, and the pace of expansion has actually increased in the last 2 years since the pandemic. If we look at the revenue of this company, then the revenue has actually gone up in the last 1.5 year from 1242 to 1685, which is an increase of about 30%. But the culprit is the net profit after tax, which was 295 crores into March 2021, which has reduced to just 227 crores, which is a reduction of about 20-22%. Now, why has this happened? The secret lies in the operating margins. So if we look at the quarterly data, what we observe is that it had peak margins of about 38% in December 20, which has reduced to just 20% operating margins in September 2020. To get a better perspective on the operating margins of this company, if we look at the yearly data over the last 10-12 years, what we observe over here is that the company's sustainable operating profit margin is about 18 to 20%. It was only in 2020 and 2021 that the company was able to achieve much higher operating margins due to supply distortions and supply demand mismatch. Now, come September 22, the margins have reduced to just 20%, profits have reduced, and consequently, the stock price has fallen. So, what this example tells us is that when you invest in a high PE ratio stock, then the room for error is very low. In fact, the normal ups and downs of business also tend to impact the stock price a lot, because too much positive expectations are built into the valuations of a high PE stock.